Welcome to Iron Financial. We're the place you come to forge a stronger portfolio, to cut through the noise, the weakness, and get right to the core of what's moving the market. Today, we are sinking our teeth into a real head-scratcher. Karman Holdings, ticker KRMN. Now, this is a powerhouse in the defense and space sector, and they just dropped an earnings report that, honestly, should have sent the stock to the moon. We're talking record-breaking numbers. But it didn't. It actually stumbled. And this, right here, this is the kind of paradox that can either forge a fortune for you or spring a trap that shatters a portfolio. Our job today? Figure out which one it is. Are we looking at a titan being built right before our eyes, or is this a trap waiting for unwary investors? All right, let's just get straight to the point. No fluff. Karman drops this absolutely stellar report. I mean, the numbers are phenomenal. Logically, that stock should have skyrocketed. But what really happened? It went down. Now, for any serious investor, that's not just a yellow flag, that's a massive, waving red flag. You've got this fundamental disconnect between what the company is actually doing, its performance, and how the market feels about it. And the only question that matters is why. Is the market just completely missing the boat here? Or is there some kind of hidden risk, something lurking under the surface that we need to drag into the light? I mean, just look at this, put it side by side. On the left, you've got a plus 47% revenue growth number. That is a company that is absolutely firing on all cylinders. It's a sign of overwhelming strength. Then you look to the right, a stock dip of 2.2% at the close. These two things should not exist in the same universe. It's like watching a champion sprinter cross the finish line and then immediately collapse. The raw data, the numbers, they're telling us a story of incredible, explosive growth. But the market? The market's telling a completely different story, a story of doubt. We're going to find out which story is the real one. So here's our game plan. This is how we're going to hammer this thing out. First, we're going to dissect this Karman paradox. Then, we're going to build the bull case. We'll call it forging record growth. After that, we have to look for the cracks in the armor. Then we'll look at how they're building the future, what their strategy really is. And finally, we'll weigh it all and deliver the iron verdict. Let's get to work. Okay, so let's dive headfirst into this Karman paradox. You know, it's a classic Wall Street mystery. You've got booming profits on one side and a bearish, hesitant market on the other. It's like a battle between the hard numbers and the market narrative. You've got this fortress of financials that looks absolutely impenetrable. But then there's this whisper of doubt. It's subtle, but it was clearly enough to make investors nervous. Our mission is to figure out exactly where that whisper is coming from. Let's start with the bull case, because on paper, this thing is built on a foundation of pure, unadulterated financial power. That Q4 revenue, up 47% year over year, that is just phenomenal. In any industry, that's fantastic. But in the hyper-competitive defense sector, that's a massive statement of dominance. And get this, a 358% jump in net income. That's not just growth, my friends. That is an explosion of profitability. And as if that wasn't enough, they topped it all off by raising their guidance for the future. You look at these numbers in a vacuum, and it's an open and shut case. This is a clear, undeniable winner. But the market clearly had other ideas. And that 2.2% drop, okay, yeah, it recovered in after-hours trading, but that initial dip is a crucial signal. It tells you that despite all those beautiful blockbuster numbers, there was something in that report, something in the fine print or between the lines that gave Wall Street pause. Our job is to find out exactly what it was, what spoke to them. All right. Let's put the market's weird reaction on the back burner for just a minute and really build this bull case from the ground up. Because to truly get a handle on Karman's potential, you have to appreciate the sheer strength of its core operations. This company, from a business perspective, is being built like a fortress. And the foundation of that fortress, the very bedrock, is its explosive revenue growth. $134.5 million. Let that sink in. That isn't just a number on a spreadsheet. That is a statement of intent. A 47% year-over-year increase. That's the sign of a company that isn't just growing, it's absolutely dominating its market. In the defense and space industry, where contracts are huge and hard-won, that kind of growth is a legitimate game changer. It shows they are aggressively taking market share and they're doing it at a breakneck pace. This is pure power. Now, let's talk about something even more important than past performance, future certainty. Karman's backlog is sitting at over $1 billion. Think about that. That's $1 billion in guaranteed, contracted future revenue. In today's choppy, uncertain economy, that's like having a vault filled with gold bars. It provides a level of stability and predictability that very, very few companies can even dream of. This isn't some pie-in-the-sky sales forecast. These are signed, sealed, and delivered contracts. It's money in the bank just waiting to be collected.
And let's be clear, this isn't just about having a safety net. This backlog is an offensive weapon. It gives them an incredible 80% visibility into their 2026 revenue target. That means they're not just hoping or guessing about the future, they have a crystal clear roadmap. This is precisely why the management team can confidently stand up in front of Wall Street and raise their guidance. It's not arrogance, it's conviction, and it's based on real contracted business that is already locked in and ready to go.
Look at this chart. This is what we're talking about. This says it all. We're not just seeing steady, linear growth. We are seeing a powerful acceleration. You go from 345 million to 472 million, and now you're guiding towards nearly $750 million. This is the visual representation of a company hitting its stride, of a well-oiled machine that's just getting warmed up. This is what pure operational momentum looks like when you put it on a slide. It's a beautiful thing. So, the big question is, how? How are they pulling off this incredible growth? The answer is simple. Smart, strategic acquisitions. And listen, they're not just buying revenue streams, they are buying capabilities. They're building a competitive moat. By acquiring a firm like Seemann Composites, for example, they're deepening their expertise in advanced materials, the stuff that's absolutely critical for next-generation fighter jets, missiles, and spacecraft. At the same time, they're expanding into new markets like maritime defense. They're deliberately becoming a true, all-domain provider. This is how you build a dominant, long-lasting franchise in this industry. Okay, I have to admit, that's a compelling bull case. A fortress of revenue, a clear strategy. It sounds great. But let's not get carried away. The market's reaction, that little dip, it tells us there's another side to this coin. It wasn't impressed. So now it's time to play devil's advocate. It's time to take a hammer to this fortress and look for the cracks in Karman's armor. Even the strongest walls can have a weak point. And here it is, the first crack, the earnings per share miss. Now look, it might seem small. We're talking about 2 cents. Who cares about 2 cents? Well, the market cares. For a stock that is priced for absolute perfection, a miss like this, no matter how small, is a major blow. This is the first chink in the narrative of flawless execution, and it was more than enough to send a shiver down the spine of the market. When you are paying a massive premium for a stock, you expect perfection. Anything less introduces doubt. Now, let's talk about the elephant in the room, the valuation. A price-to-earnings ratio of 1,200. Let me say that again, 1,200. That is not just high. It's not just rich. It is in the stratosphere. It's astronomical. This is a company that is priced not just for perfection today, but for a flawless, unblemished, straight-line-up future with zero room for error. For most companies, a small miss on earnings is a little bump in the road. For Karman, with a valuation this stretched, it's a potential earthquake. This is a major, glaring risk that investors simply cannot afford to ignore. There is absolutely no margin of safety here. And there's more. All those great acquisitions we talked about, they come at a cost. And that cost is debt. With a debt-to-equity ratio of 1.31, Karman is taking on a significant amount of leverage to fuel this growth engine. Now, this isn't necessarily a deal breaker on its own, but it adds another layer of risk, another layer of financial pressure. It means they have to keep firing on all cylinders. They have to manage this debt. They have to integrate these companies perfectly, and they have to maintain this insane growth trajectory. It's a very high-wire act with very little room for a misstep.
So beyond the financials on their own books, Karman is facing a whole host of significant external challenges. They have to somehow seamlessly integrate multiple complex new companies, a task that, frankly, most companies fail at. They have to navigate a global supply chain that is still, to this day, incredibly volatile. They have to compete against some of the biggest, most established giants in the entire industrial sector. And let's not forget the biggest risk of all, their near total reliance on government contracts. Any change in defense spending, any budget cut in Washington, that could have a massive, direct, and immediate impact on that billion-dollar backlog we were just praising. These are serious, serious hurdles they will need to overcome. Okay, the bear case is strong. I'll grant you that. That valuation it's really stretched. But let's not lose sight of the bigger picture here. Investing is always a forward-looking game. You're buying the future, not the past. So the real question we have to answer is whether Karman's long-term strategy is powerful enough to justify that high valuation and overcome all these risks we just laid out. Let's take a closer look at what exactly they are trying to build here. You know, the CEO's own words here speak volumes. Listen to the language he uses. Strategic investments. This isn't a company that's just getting lucky or riding a temporary wave. They are deliberately and methodically building a machine designed to capture what many experts see as a generational supercycle in defense and space spending. They look out at the world, they see growing global instability, they see intense technological competition, and they see a massive long-term tailwind. They're positioning KRMN to be the absolute go-to provider for advanced materials and complex systems for decades to come.
And look, this isn't just cheap talk from the C-suite. KRMN is putting their money where their mouth is. They're backing it up with their official guidance, which, and this is a crucial point, is even more optimistic than what the analysts on Wall Street are predicting. They are projecting over 50% revenue growth for fiscal year 2026. Now, when a company's own management team is more bullish on its own future than the professional analysts covering it, that is a powerful signal. It signals real internal confidence in their contracts, their pipeline, and their ability to execute.
But, and this is a big but, that internal confidence has absolutely not created a consensus on the outside. And this is why the risk for an investor today becomes crystal clear. You've got price targets ranging from as low as $37 all the way up to $135. That's not just disagreement, that is a deep, fundamental division on Wall Street about what this company is actually worth. It is a classic battle. On one side, you have the bulls, who see a rocket ship fueled by undeniable growth, and on the other, you have the bears, who see a house of cards built on a dangerously high valuation. The stakes for anyone buying the stock today could not be higher.
All right, we've laid it all out. We've seen the bull case, a case built on a foundation of solid steel. We've examined the bear case, which points to some very real cracks in that armor. We've looked at the numbers, we've analyzed the strategy, and we've weighed the risks. Now, it is time for the moment of truth. Let's hammer this thing out and deliver our iron verdict.
So, here it is, the final weigh-in. The bull case is clear, it's compelling, and it's built on the undeniable strength of record revenue, a massive, locked-in backlog, and a very smart, aggressive acquisition strategy. Operationally, this company is an absolute juggernaut. But the bears have an incredibly powerful counterargument that you simply cannot dismiss. A sky-high, stratospheric valuation that leaves zero, and I mean zero room for error. So you're left with this dilemma. The company's foundation is solid as a rock, but the price you have to pay for a piece of it is a major, major risk.
So here's the bottom line. Let's cut right to it. KRMN is a fantastic, well-run company with a very bright future in a critically important industry. The operational story is pristine, you can't argue with it, but the stock price is a massive hurdle. And the question you as an investor need to ask yourself is this: are you willing to pay a huge premium for a great company, knowing full well that any tiny misstep, any little stumble could cause a major, painful correction? Or is the risk that comes baked into that price tag just simply too high to justify? KRMN is building a fortress, no doubt about it, but for new investors, it could also be a trap. The choice is yours.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to